This video is the ultimate guide for sellers considering seller financing on their home. In this video, you'll learn about the benefits and the risks, how to mitigate those risks, and everything else that you should know if you're jumping into seller financing. Seller financing is a great way to attract more buyers, sell your home quicker, and make some extra money, but you need to know the risks that are involved. Don't worry, I got you. I'm Courtney Maddox. I'm a real estate agent in Utah County. I sold my own property with seller financing last year, and I would do it again in a heartbeat. If you haven't watched my video about seller financing 101, go watch that. It'll tell you the what's, the how's, the why's of seller financing, all the ins and outs. If you already know that stuff, let's jump into it. You may be asking yourself, why would I seller finance my home if I could just sell it outright and cash out completely? Why would I seller finance? Now, the truth is, if you were to sell it outright, you would cash out, you would be done with it, and sometimes that is the best route. But if you're not in a hurry and you're interested in making a little extra money, seller financing might be intriguing for you. Also, if your home is not selling, which a lot of them are right now, seller financing might be a really good idea. Let's go through some of the benefits. Back in 2023, my husband and I had an investment property we were looking to cash out on. We thought, hey, why not list it with seller finance, see what happens? And honestly, it blew up. We got multiple offers and we blew through the record price for a townhome in Vineyard, Utah, and the buyers closed in 2.5 weeks. It was honestly insane. So oftentimes the benefit of seller financing and offering seller financing is that you sell quicker. Another benefit is that buyers are often willing to pay a premium for seller financing if you can offer them a good rate. And since seller financing is not contingent on an appraisal like a typical loan would be, they can waive their appraisal contingency in the contract. Another benefit of going this route is that the buyer can bring in a down payment that cashes you out on some or all of your equity that you would have gotten by selling it anyways. The buyers are also going to send you monthly payments that cover your mortgage, plus a little cream on the top. Who doesn't like extra cash every month? The thing you may not have realized about those payments is that they're amortized. What does amortized mean? Amortized means that the monthly payment on the first month of the loan versus the last month of the loan are drastically different as far as principal and interest go. Principal is the part that's paying down the loan, and interest is just cream on the top for the lender, which would be you as the seller. Imagine this as if you're making 30 cupcakes. You have 30 cupcakes worth of batter and 30 cupcakes worth of frosting. Now, non-amortized payments would just be equal cupcakes and equal frosting on every single one. Amortized payments would be the equivalent of the first cupcake being this much batter and this much frosting, and slowly graduating to the last cupcake being this much cupcake and this much frosting. And for the most part, if you're seller financing, you're probably not carrying that loan for the full 30 years, even though the payments are amortized over 30 years. So if you're doing the first 5 years of this 30 years, most of those cupcakes are going to be this much cupcake and this much frosting. Frosting is interest. That is literal money in your pocket. Are you a good candidate for seller financing? When my husband and I were selling that property, there's a reason we chose that specific one rather than the other investment properties that we have, because that one happened to have an insane interest rate in the 3s as well as tons of equity built up since we bought it. These two things, good interest rate and a lot of equity, leave a ton of wiggle room in negotiations and make a really appealing deal to a buyer. In my Seller Financing 101 video, I talk about the different terms or levers associated with seller financing. Now, this is a very appropriate time for us to talk about those terms. Now, I need you to imagine 3 levers in a row and then a little box at the end that says monthly payment. The levers are purchase price, down payment, and interest rate. And as we adjust these levers, this monthly payment changes. As you adjust the purchase price up and down, the monthly payment goes up or down. If you adjust interest rate up or down, the monthly payment also goes up or down. Down payment has an inverse reaction, meaning if you go up with the down payment, the monthly payment goes down. And if you go down with the down payment, the monthly payment goes up. Now, on the other side, you have this honorary lever that doesn't affect the monthly payment, but it's still a point of negotiation in the contract, and that is the balloon. Some sellers are only willing to carry this financing for 2 or 3 years. That's all that makes sense for them. But if you have one of these other levers that you would like to max out, the balloon is a way to negotiate that for the buyer. Of course, they would love you to carry the financing as long as possible. So you really need to figure out what's most important to you. If it's getting the price that you want, then the purchase price lever is going to go up. The buyer's monthly payment's also going to go up. So you may need to adjust the other levers in favor of the buyer to make it a favorable deal for them as well. Now, as a seller, you need to know the risks involved. I'll also tell you what is typically done to mitigate those risks. So if you have a mortgage on your property, most, if not all, loans are going to have what's called a due on sale clause. That means that if you sell the property, the entire note, the entire mortgage is called due by the bank. So technically, if you sell the property, you do owe the bank all that money. There's a few things that we do to build a safety net around this due on sale clause. One of them is to use a professional third-party escrow company to take monthly payments from the buyers and pay your mortgage for you and then cut you a check for the extra. This keeps it really clean, and it makes sure that the buyers are paying on time and paying the right amount and that the bank is always paid. Another thing that's important to do, even though it may seem redundant, is to keep your homeowner's insurance on the property so that you don't raise any red flags to the bank. The buyer is also going to get their own homeowner's insurance policy. But in my Seller Finance 101 video, I mentioned something that's very popular in Utah that's called a contract for deed. And this is what we did on our property that we sold with seller financing. Contract for deed means that over the period of the seller financing, title actually remains with the seller of the property, and the buyer continues to make the payments that are agreed on. And at the end of the balloon is when title transfers. So this is a really good way to mitigate that risk. Another risk to you as the seller is the buyer defaulting on their payments. What if a year down the road, buyer just stops making payments? What are you supposed to do? So the procedure at that point would be a foreclosure. You would have to foreclose on them the same way that a bank would. Foreclosure takes about 4 to 6 months. And so I always recommend having 3 to 6 months worth of mortgage payments in reserve. If you've taken a down payment from the buyer, that's a great place to take the money from. And here's another benefit of the contract for deed. So because title hasn't transferred, you still own the property. So rather than having to foreclose on a buyer who's defaulted on their payments, the process is actually called forfeiture, and it only takes about 30 to 60 days. And it's much cleaner and much less expensive than foreclosing. The third major risk involved in seller financing would be buyer damage. Requiring a down payment is a really good way to mitigate this risk for 2 reasons. First of all, the buyer has skin in the game. Second of all, you can reserve that cash just in case. That way, if there's any issues with the buyer causing a lot of damage, you have some cash in order to remedy the situation and be able to do something with your property. Another thing to be aware of is that if you have a mortgage on the property, that debt stays in your name until the buyer pays off the property at the end of your balloon. So it's important to work with a lender and an accountant to make sure that this is okay with what your future goals are. If you're trying to buy your next home, this is going to affect your DTI, it's going to affect your credit because you still have this mortgage in your name. You're also going to want to work closely with maybe an accountant who has some experience in this field because it's going to affect your taxes one way or another, but figuring out how to structure it and figuring out how it's going to affect you. Another thing, and this is huge, I can't tell you how many homeowners in general forget about this, but checking your mortgage statements every single month and every year to watch for your escrow account changing. Because you as a seller are responsible for making sure that the escrow company and the buyer are aware of this increase so that their payments can reflect that. My last pro tip would be using a title company who has experience with seller financing. Because the title company is going to be drawing up these loan documents and this note, you want to make sure that they know what they're doing and they've done this before. Of course, it goes without saying that it's really important to work with a professional real estate agent who also has experience. You need someone, whether it's an attorney or a real estate agent, to review the contract and go through all the fine print details because seller financing is going to have many more pages to the contract, many more addendums, and it's going to be messy and sticky if you don't know what everything means. If you liked this creative strategy for selling your home quickly and making extra money, then stick around and subscribe because I'm obsessed with those 2 things. If you need any help structuring a seller finance deal or figuring out if you're a good candidate, call or text me at this number. I'm always happy to help. We're done. That's it.